Good afternoon, everyone. This is Brad Matheny. Today's the 21st of July. Very special day for me and my family. We're going to go out and celebrate today. I won't tell you exactly what it is, but big, important day for our family. Now, today was a very crazy day for everyone. And I know that I posted up this video back over here. Let me make sure I've still got it. Yeah, this buckle up video a couple of weeks ago. It's had a number of comments and boosts and what have you. Very interesting move in the markets, particularly in gold and silver today. You can see these are my typical gold and silver charts. You've seen these before if you've followed me enough. Gold is making a big move. 34.10 already on the close. It's making a big move here. And in reality, guys, this has been telegraphed for months. I mean, months. You go back and look at my older videos, you'll see that I was talking to you about what gold and metals are going to do, the different stages they're going through. And I'm going to tell you right now that this move here is just, I believe, the beginning of what's going to come. It's really going to be impressive. Silver, same point in time, legging higher, trying to move higher, targeting this $40 level to $43 level. Really looking at trying to get up into this zone right here. And it all comes down to the fact that, actually, let me do this because it's a little higher. It's actually this zone between here, $42.70 and roughly $40.10. That's the zone silver's trying to accelerate to right now. We've got a series of legging events taking place that should put it up in the $42.50, $43 area fairly quickly. When I say fairly quickly, I'm talking a lot quicker than you guys probably think. But again, what's going on with the markets? So now take a look over here. Let me see if I can go to, this here. This is the Mint Main. What happened with this big rollover today? Very heavy selling volume going into the end of the day here. What the heck is going on? Well, I'm not going to tell you, what my cycle patterns say. I'm not going to tell you, other things. I told you I won't be talking about that much longer, or at least in the near future. But, watch this video. And what I wanted to show you today was the fact that, we're looking at an event cycle, which could be rather interesting. And I set these 4 charts up for you. Now, this is daily. This is the, consumer service, debt service payments as a percentage of disposable income. Okay. Now, I want you to understand, this is credit card debt service payments as a percentage of disposable income. So again, as we get into this upper area, this means it becomes more of a drag on the consumer. When we're in this lower area, we're down here in a very low rate of consumer, let's call it distress related to paying bills. We're currently at a pretty high level comparatively, not back in 2000 levels, not back in 2005 levels. Remember, we were at zero interest rates back here, inching our way up. And we started inching our way up, if I remember right, 2004, 2005. And by 2008, 9, 10, we were in this crash where zero interest rates stayed in play. Zero interest rates stayed in play during COVID. And here we are back at 5.5% Fed funds rate, or close to that. So now I've highlighted these areas. This is IYT, divide by gold, transportation index, divide by gold. I want you to understand here in this transportation index divide by gold that we're down here at or near these COVID low levels. So we're already pretty much in an economic contraction. Okay, why are the markets moving higher? Pure speculation, in my opinion. We're already down below these extreme low levels. You could argue or ask yourself, Brad, doesn't that mean that the markets are going to be basing and bottoming here? Well, maybe. Look at what happened back over here. We came below those levels. We rolled into many years. 2008, 9, 10, 11, 12. Finally, in 2013 and 14, we started to climb back out of it. That was a 6-year drag on the markets before we started to get some real growth. And remember, until we start to see this move upward, we're not going to be seeing any real growth in the U.S. and global economy. Now, this up here, top right, USCIR, this is the core inflation index. You can see we've just had the highest inflation index pretty much since the 80s. And again, the 80s were very high. And I believe that we're going to be looking at increased inflation continuing to play out. So where we're at right now, I believe we're going to be looking at inflation moving back up into the threes, probably 3.4, 3.6, maybe with tariffs. It could play out okay, but I believe this inflation is going to potentially cause the Fed to raise interest rates, and that's going to put more pressure into a downward decline. Now, this is really why I talked to you guys about this image, this buckle up special update. I really wanted you guys to understand that even though it looks like we're, rallying like crazy right now, and yeah, we're up. I mean, the market's been up 30% since the lows in April. Someone reminded me of that just last week. Yeah, I mean, 30% off the lows, let's call it what it is. That is a tremendous year for the markets. 30% in 1 year off the lows. I'm telling you guys, it's really never happened. Really never happened to see a 30% rally other than maybe COVID. And I can check. COVID came off the lows. Yeah, they came up more than 30%. So the only other time we've had this type of a rally was COVID. Now, I believe that the markets are still in a very strenuous market environment. Okay. I honestly believe that this weakening trend, gold, I believe, and let's talk about gold. I'll show you again. Gold, I believe, is hedging extreme risk in the markets right now. And that is why gold continues to push upward and silver continues to push upward. It's not because there is a massive crisis event coming into play. It's because we have continued to run the zero interest policies and the global economic expansion policies, the easy money policies for more than 15 years. Okay, we've really been dumping money into the economy. And as I mentioned to you, if you figure out what the derivatives risk is in the economy throughout the world over the last 12 to 15 years, my guess is those total derivative risks have increased by more than 40 or 50 times what they were in 2008, 2009. So, the crisis, the potential for a crisis in excess of 40 to 50% times the crisis mode that we had in 2008, 9, 10 is there. Okay, it's just right under the surface right now. And really, that's why you're seeing metals hedge and you're seeing speculation in the SPY right now. Now, the SPY has turned into a gambling center. It really has. I saw a report the other day that there was 60 to 65% of daily volume on the SPY is zero DTE options, 0 day to expiration options. You're talking about a gambling center, a full-on speculative bubble. And I believe the bubbles, when they burst, are going to put the S&P into a consolidated downward cycle trend into 2026 and 2027. Potentially, moving down into these extreme lows, possibly 410, 402, really moving into, let me get a dark red here or a bright red, really moving into an excess bubble correction. Now, I believe this is the end of wave 4, so let's put wave 4 right here, and this is wave 5. So, a wave 2 correction at this point would put the lows probably in this 440 to 410 area, maybe a little higher, maybe up in this area, 480 to 500, let's call it 460 to 500, 509. Those are the two areas I think are going to hold up as support. And that will give us a very clear breakaway type of a pattern moving into 2027, well, late 2026 and 2027. Here's wave 3, wave 4, wave 5A, wave 5B, wave 5C. Get the idea? That's kind of what I'm expecting to see happen, guys. We're going to be looking at a pullback here, or a B pullback, with an A up here and a C somewhere up here. So now, what I'm telling you guys is, again, what I tried to warn you back over here in this video. Be prepared for extreme volatility. We've got big Mag 7 stocks earnings coming out. Could be some very wild, volatile moves. We've got tariffs coming back. We've got restructuring coming back. We've got consumers moving into a very consolidated mode right now. Again, consumers are dealing with this risk factor right now. And if I can show you over here, we're looking at the Fed funds rate moving into hostile territory. Right now, this is my weekly fear index moving higher while we're moving up, staying very elevated. And remember, last time we had this type of elevation was back over in 2022, moving through that correction with the Fed. But what's really important, let me find it for you, is the fact that the Fed funds rate hostility index is now based and moving higher. What does this mean, guys? What does it mean when the Fed funds rate hostility index is inching upward? It means that as we come over here, look at this low, start to get this upward movement here, it means that we're seeing consumers and borrowing really start to buckle from this extended support. Now remember, this is basically, here's the beginning of the year. There's April. April, the Fed funds rate didn't really cause any problems. It was not an issue. Fed funds rate has now become an issue, potentially an issue. Okay, you can see how we started to raise rates back over here, telegraphing it. And you can see how as we raised rates moving across here, we saw the markets roll into this trend with about a, let's call it a 6 to 8 month lag time right here. Now we've got this low setting up in April. We're currently setting up over here into moving into August. Do the math. If we get a 6 to 8 month lag time right here, we're looking at a potential downward trend in the markets setting up over the next 30, 60, 90 days. Okay? So, what I'm trying to show you guys here is the reason why my analysis is still bullish. We have no indication of a breakdown yet. So there is nothing I'm telling you to say short or load up or it's a top. I want to be very clear. I'm not calling this a top in the market right now. I'm not telling you to load up on shorts. I'm not telling you to do anything other than protect your capital, move to cash if you can. I'm going to tell you right now that, this week and next week may be the last chance you have to move to cash. It really is a great time to move capital away from the markets right now. No matter what happens over the next 20, 30 days, you will survive. I promise you. And if I'm right and the markets do contract, you'll be thanking me in about 4, 5, 10 months. If I'm wrong and the markets don't contract and we continue to get a bit of a rally, well, you lost maybe 4, 5, 6%. We'll see what happens. Okay. But again, I think, is my personal opinion, the data that I'm looking at, I think is very indicative of a strong recessionary trend. And this is probably the best example here, other than maybe this, which is, let me find it right here. Other than the fact that we have stayed in this lower channel, we are weakening through July. We're not seeing any real growth here, and my indicators are indicating downward cycle trending. So what we're looking at here, guys, is a moderate decline in price trending from basically right here, which would be roughly the lows in April. Let me see if I can get rid of that. From right here. And of course, it's not a straight line, but it will be when I get to this point. Right in that area, the market ratio should be ratio index, not ration or rotation index, moved into bearish trending. So this entire move up on the SPY right over here, this entire move after these lows has been basically a pullback, upward pullback in a downtrend based on my custom indexes, my specialized data. And what that means, again, is without telling you it's a top, without freaking you out, without setting up all the trolls who want to come out at me and say, well, you called the top, well, you called the top, well, you called the top. You know what? What is a top? A top means this. This is what I'm telling you. The markets right now are seeking a top. A top means it rallies up to find that resistance area, rolls, and likely rolls into an excess phase peak pattern. That's what a top is. So understand, when I say it's setting up a top, that means we're in this mode. Somewhere in this upper mode, going higher, looking for this top to set up. It could be now, could be next week, could be 2 weeks from now. I don't know. I mean, what I'm telling you is the data is saying that the markets are weakening. The Fed funds rate, hostility rate is extremely high. There's a very good chance we're going to see a contraction in the market. And again, we're already into recessionary trending right here. So understand that we're in a big speculative bubble. And now if you look at this, we don't have any data going back past here. Let me see. Probably if I come over here. Yeah, we don't. So let me go to transportation index. There we go. So now you can see how we blew into this excessive trending level up here. Roughly right over in this area. Let me set the lines again. Really in the 90s. But let's use this area here. We'll set that level, and we'll set that level. So basically 2.5 and 2 on this ratio. And where we're at here is you can see this big growth phase through the expansion of the dot-com bubble. That's this area here, running up. That was a housing market bubble as well. And running up through 9/11, continuing to rally into this recessionary trend here, into the 2015-16 breakdown, into the COVID breakdown, which remember was the entire world shutting down. And now we're actually below that level right now. Where we're at right now, guys, in my opinion, we're in a recession because it doesn't look like it. Consumers are struggling. Businesses are struggling. Retail is shutting down faster at a faster pace than at any time during COVID. We are in a high price because of this here, because of this massive inflation. We are in a high price economic recession that essentially needs to unwind. And the only way that can unwind, in my opinion, is to deflate the global assets and hard assets. That includes real estate, commercial, stocks, global stocks. The only way this can unwind, in my opinion, is to deflate. And I think the Fed's going to be trapped as inflation continues to bump up, probably because of tariffs and other news. Fed will have to keep rates higher for longer. And that means that we're going to be looking at extended pressure in the markets, which means we're going to be looking at an extended potential downturn in the global and U.S. markets. So be aware. Pay attention to kind of what's going on under the seams. Take a look at your real estate. Drive around, find out how many retail shops are empty and trying to go for lease. Okay, yeah, there's still people out there spending. There's still people out there that have money to spend. But I'm telling you, if you go pay attention to what's going on around the markets right now, around the buildings, you're going to find quite a bit of empty commercial and retail space that's just looking for someone to come in and buy or rent. Okay, let's go ahead and let this go. Again, appreciate all your time. Give you a heads up. Remember, I am not calling a top right now. I'm going to tell you that I think we're very near to a top. We could go another 3, 4, 5% higher, especially this week on earnings, or we could get a whole lot of price volatility if earnings come in unexpectedly and or we get tariff news. So be aware that the setup right now, this is not growth. This is not growth. Look at here how we went through COVID. We went through this deep, deep low. We started to get growth back over here at the end of 2020. The stock market rallied through most of 2020, but we don't have that growth yet. We're looking at, this is monthly, all of July, moving into August. We're still pretty weak here, guys. And we're elevated here. Notice that when we were at 2020, look at where we're at here. There's January 2020. Look at where we're at right here. It'll show you here. So here we come through 2020, elevated, downward recessionary trending all the way across here. Then we get this breakdown. This is COVID hitting. This is really the breakdown in the market. Now we start to, after we get that moderate recovery, we start to get into a real recovery phase here. So this whole breakdown right here, we haven't even seen that yet here. And again, this is consumer payments, debt service payments as a percentage of disposable income. We haven't even seen this relate into this mode. This is what's coming, is that you're going to see essentially consumer debt payments become more and more laborious for the average consumer. Housing, basic costs, housing, insurance, rent, everything is sky high right now. This is going to end up being a real issue for consumers, in my opinion, over the next 10, 12 months. So we'll see how it plays out, guys. I see this, like I said, right here as a very clear warning that we are in a recessionary downturn type of a market, have moved there suddenly. This is monthly. So look here. From January of this year, okay, all the way until now, we've gone from moderate, okay strength to early recessionary trending. Really, early recessionary trending. And again, when we get into that type of a mode, remember, we're talking about back here in 2008. Oops. So look at where we're at here. We get that sudden breakdown. Boom, boom, boom. Right here. Into recessionary trending. Look at what happened right over here. This is the same time frame. Right here. From here to here. The exact same time frame as right over here. If we then stay in a consolidated zone, a consolidated downward zone, we should be looking at hard asset contraction. Homes, commercial real estate, economic activity, speculative bubbles bursting. That's what this is suggesting is taking place, is that we are, really kind of right here. I'll get rid of this. We're really kind of right in this area, leading into this, coming down and stalling. And I think that's what I'm trying to suggest is likely to happen this year in the SPY. I think we're looking at a moderate breakdown, stalling into late 2025, early 2026, basing and trying to rally our way back out of it. Now, this took 3-4 years. I don't think it's going to take this long. I think by 2028, we're going to be rallying again. But I think we're looking at a moderate kind of collapse in hard asset values. Okay, guys, that's it for now. Talk to you later.